Talk to us a little bit about whether or not you see this unchanged number actually indicative of what we might see trend-wise. What do you think?
Okay, good morning, everybody. Good morning, Mike. So this is actually a pretty good report. Although the number is the same as last month, and we are contracting again, and not marginally, we're contracting moderately at 47. I look at this thing from a demand and output and input standpoint, and the demand and the output side shifted to the positive. And back to Mike's comment here, the new order level actually contracted less than it has in quite some time, which is very good. We've been looking for new orders to come back in because we don't have a backlog really left anymore. We need the orders. So that did show up. And then on the output side, we saw production ease a little bit as we expected to align better with forward demand. And we saw employment ease again, which is a very positive thing. So, and on the input side, everything was flat. Mm-hmm. So we did see the suppliers deliver a little bit faster. I'd like to see them deliver a little bit slower. But the manufacturing inventory number started to contract less, which is all good. So even though the PMI number is the same, the 5 elements that make it up did shift, and they shifted for the positive, I think.
Yeah, but the prices didn't, almost at 50. What do you make of that?
Yeah, that's not good. So, the thing that I've been saying is going to help the new order level come back is prices dropping and lead times declining. So we did have lead times decline again. We're still well off the historical trough on lead times, but they're declining nonetheless. The problem here was prices didn't contract or expand at all this month, so they stayed the same. What we had was an energy market easing along with aluminum markets, but we had that offset by plastics growth, as well as steel. And the trend is, as you see now with OPEC pulling more barrels out of the production pipeline, is likely that energy is going to go up again. I'm not sure how much, but it probably will go up again, which will be a headwind for the month of December. So at this point, I would say prices are probably going to rise. I mean, we've got steel at $1,000 a short ton, which is, the historical is about 700. So it's still very high, and the way they're managing that is through managing capacity, and capacity is taking capacity out is allowing prices to stay high.
Tim, walk us through the read-through of that then into the inventory story. That's some sort of the move that you're seeing here from October to November. We go from 6 to 17% in terms of inventories. At the same time, new orders pull back. Do we start to see this inventory story last through the holidays?
Yeah, so we've been talking about the large inventory, the entire supply chain inventory, which includes new order levels, it includes manufacturing inventory, and it includes customer inventory. That's the inventory of our panelist companies that their customers are holding. So in this month, we saw lead times come down a little bit. We saw new orders not contract as strong, which would indicate that, okay, on the ordering side, the over-ordering is over, and we're starting to reload the order book, which is very positive. We got to get that backlog back up. The customer inventory number is actually on the high side of just right or on the low side of too high, which is not very good for the future. It's not bad, but I like to see it too low because that means that customers are still drawing material from the panelist companies. And the third element here is really manufacturing inventory, which our companies have been watching very closely from a liquidity standpoint in the anticipation that if the bottom fell out, they're not stuck with all this material that they can't convert. And we've been at historical low levels for a long time now. And I'm waiting for that inventory number to get back up in the high 40s, preferably low 50s. There was years where we hung between 49 and 52, and now we've been sitting down at the 44, 45 level. So I think there's still upside there on the inventory side, probably into January, February. I don't see that inventory number coming off its 45 or so point in December, because I think a lot of companies are going to make sure that they close the year on a strong liquidity position.
Hey, Tim, the market, and there's also Goolsbee comments. He's talking about inflation. He's talking about a lot of disinflation from supply shocks, maybe not steel, but there you go. The market otherwise is taking it relatively in a Goldilocks fashion. From where you sit, is that legit?
Well, I've been saying for 3 or 4 months now that I believe that we're in the trough, and I think we're at the bottom of the trough. And, the 46.7 kind of supports that. So the negative of that is that I don't see us climbing out of the trough really quickly. It's going to be slow. We still have the pandemic impacts, and we had a huge, climb up. We had a huge overordering situation. We've had a year and a half of no orders to burn off that backlog and take care of the overordering, and here we sit. So we're 13 months now into a PMI contraction. outside of the Great Recession, these things normally last about 6 months, and we're in month 13 now. So again, we're setting new barriers here because of the pandemic. I don't see us going 18 months like we did at the Great Recession, but climbing out of into a decent expansion, meaning 51, 52, we're probably looking at the end of the first quarter.